Today we are going to break down something that touches almost every big financial move you'll ever make, and that's your credit score. Really, truly understanding this number is the key to your whole financial future. So let's just dive right in. So let me just start by asking you a question. Is it possible that one little three-digit number, a number you might not even know off the top of your head, is quietly siphoning thousands of dollars out of your wallet? Well, for millions of people, the answer is a big, fat yes. Take a look at this. $5,000. And honestly, that's probably on the low end. This is roughly how much extra money someone with a poor credit score pays in interest on a totally normal car loan compared to someone with a good score. I mean, just think about what that is. That's a vacation, a huge boost to your savings, gone.
But, and this is the important part, it's not a life sentence. Not at all. We're about to show you exactly how these scores work so you can grab the wheel and keep that money right where it should be, in your pocket.
Okay, so first things first. What in the world is this number? I know it can seem super mysterious, like some kind of magic formula, but the idea behind it is actually really, really simple.
At its core, your credit score is just a number that falls somewhere between 300 and 850. The easiest way to think about it is like your financial report card. Lenders, banks, credit card companies, they use this score to get a quick idea of how likely you are to pay them back. So a higher score tells them you're a safe bet, and a lower score, well, that's a bit more of a risk. Now, there are a couple of different ways to calculate this score, but the one you're going to hear about 99% of the time, and the one that pretty much all U.S. lenders use, is the FICO score. So for our purposes, that's the one we're going to focus on.
So, where do you actually fall on this scale? This chart breaks it all down. Anything over 800, that's excellent. You are a lender's dream come true. From 740 up to 799 is very good, and 670 to 739 is considered good. If you're in this zone, you're going to get some pretty great interest rates. Once you dip below that, you start getting into the fair and poor ranges, and that's where borrowing money gets a lot tougher and, you guessed it, way more expensive.
And just to give you some perspective, the average credit score here in the USA is right around 715. So if you're somewhere in that neighborhood, you're right in the middle of the pack. It's a pretty good benchmark to keep in the back of your mind.
Okay, so this brings us to the million-dollar question, right? How is this number even calculated? What's the secret formula they're using? Well, guess what? It's not a secret at all, and that's exactly what we're going to get into next.
All right, let's pull back the curtain. There are 5, and only 5, key things that go into calculating your credit score. If you can understand these 5 factors, you've got the keys to the kingdom.
This right here is the whole recipe. And you can see right away, not all of these pieces are the same size. Not even close. Just 2 of them, your payment history and this thing called credit utilization, make up a whopping 65% of your entire score. So let's break down each slice of this pie.
Okay, the undisputed heavyweight champion of your credit score is your payment history. This chunk is worth 35%. And it's as simple as it sounds. Do you pay your bills on time? Every single late payment can put a ding in your score. So this, right here, is the most important habit for building good credit. It's all about consistency.
Right behind that, coming in at a close second with 30% is credit utilization. Now, that sounds kind of technical, but it's really just the percentage of available credit you're using. So say you have a credit card with a $10,000 limit and you've got a $1,000 balance on it. Your utilization is just 10%. The rule of thumb here is to try and keep this number below 30%, because if those balances get too high, it can look like you're stretched a little too thin.
Next up, making up 15% of your score is just the age of your credit accounts. It makes sense, right? A longer track record of you borrowing money and paying it back responsibly is always a good look. This is exactly why you should really think twice before closing your oldest credit card, even if you don't use it anymore. That history is actually super valuable.
All right, for the next 10%, we have something called credit mix. Basically, lenders like to see that you can handle different kinds of debt responsibly. This might be a mix of what they call revolving credit, like your credit cards, and installment loans, like a car loan or a mortgage. It just shows you're a versatile borrower.
And finally, the last 10% comes down to new credit. Every time you apply for a new loan or a new credit card, it creates what's called a hard inquiry on your report. Now, opening a bunch of new accounts in a really short period of time, that can be a bit of a red flag to lenders. It might make them think you're in some kind of financial trouble. So it's always best to be strategic about when you apply for new credit. So we get the what and we get the how, but now let's talk about the why. Why does any of this even matter? Well, because this little number has a huge, huge impact on your real life and on the actual money in your wallet.
Let's go back to that car loan for a second.
With a very good score, maybe your payment is around $550 a month, and you'd pay about $3,000 in total interest. But with a poor score for that exact same car, you could be looking at a $700 monthly payment, and you'd end up paying over $8,000 in interest alone. A better score here literally means thousands of dollars stay in your pocket.
And hey, it's not just about loans, not by a long shot. Your credit score is kind of like a gatekeeper for all sorts of things. It decides if you get approved for the best credit cards, what kind of interest rate you get on a mortgage, which can save you tens of thousands of dollars, and even whether a landlord will rent you an apartment. Heck, in some places, it can even affect how much you pay for car insurance.
Okay, are you feeling a little motivated? I hope so, because all this knowledge is only powerful if you actually do something with it. So let's wrap this up with a super clear, super simple plan you can start using today to build a great score. Here it is, your 5-step game plan. Number 1, pay every single bill on time, set up autopay if you need to, just don't miss one. 2, keep your credit card balances low, way under that 30% mark we talked about. 3, keep those old accounts open. Let that credit history grow. 4, just be thoughtful before you apply for new credit. And 5, check your full credit report, which you can do for free at least once a year. You want to catch any mistakes that might be unfairly dragging your score down.
At the end of the day, just remember this. Your credit score is not a judgment of who you are as a person. It's nothing more than a summary of your financial habits over time. And if you focus on building good, consistent habits, a great score will just happen. It's the natural result.
So I want to leave you with this question. After everything we've talked about, what's the one thing, the first step, that you can take this week to start improving your score? Maybe it's just setting up one bill on autopay, or maybe it's paying down that one high-balance card. Just decide on one thing and go do it. Hey, if you found this explainer helpful and you want more complicated stuff made super simple, do us a favor and hit that subscribe button. Thanks so much for watching, and we'll see you in the